today, that's not meant to happen. The DFA daily to the 18th of August 2021. Hello again, it's Martin North from Digital Finance Analytics, working latest posts covering finance and property news with a distinctively Australian flavour. In today's post, we look at the property bubble and what may happen, what's happening over in New Zealand, and the latest retail figures from the US, which are down, and that drove the markets down as well. And finally, Domain has handed back some of the JobKeeper payments they received, so kudos to them. But we start with an article from the Australian Broker which reports that Australia's property bubble could burst if one of the three pillars that have created the boom were to be removed. The market has seen unprecedented growth since the initial phase of reopening after the 2020 COVID lockdowns, fueled by the perfect storm of low interest rates, government subsidies, and a local market driving demand. According to Dr. Diawasi Maradasamo, chief economist at PRD, should these key factors change, we could see the property bubble burst. At the moment, the reason why we have this bubble is because we're still sheltered from international demand, she said. This is all local demand from within Australia, and it's been incentivised by government policies in the housing market. Whether that's first home buyers or single parents, regardless of demographic, the government is pushing for home ownership. You've got that incentivisation from the government, and then the other side, which is very low interest rates and home loan rates. Those three factors are what is creating the bubble and protecting the Australian property market and pushing it up and up and up. It could be a massive burst, or it could be what we're starting to see, which is a correction or slowing down with prices stabilising. But for any correction to happen, the three things need to change. Those three things are relatively simple, but any burst in the Australian property bubble is based on them. If it's the sheltering of international demand, if that changes, that means that there's going to be more demand in the market and people aren't going to be able to fulfill it, she said. They won't be able to compete and afford higher prices anymore, and that's when we'll see a correction. If there's any more mortgage stress because interest rates have changed to a level that people can't afford mortgage repayments, or if the government does not inject another new policy to assist people, that's when we're going to start seeing people sell as a lower price. And we're not talking about a burst that's going to happen immediately. It's going to be like a pumped up balloon deflating, she said. Now, over in New Zealand, they began a strict nationwide lockdown on Wednesday, with news that there were 5 cases of COVID-19 in the community and confirmation that it was facing the Delta variant. A further 4 cases have been identified, all connected to the first case discovered on Tuesday, the Ministry of Health said in a statement. And the original case has been confirmed as Delta, it said. That was the first community case since February. Prime Minister Jacinda Ardern put the nation on a 3-day lockdown from midnight on Tuesday, assuming the unvaccinated Auckland man in his 50s had the more infectious Delta strain. Largest city Auckland and the nearby Coromandel region, where the man and his wife visited, are facing a 7-day lockdown. It's New Zealand's first nationwide closure since the initial pandemic response over a year ago, and it has the potential to rewrite the economic and fiscal outlook. Some economists said the central bank will now hold off delivering a rate increase expected later today to gauge the impact of the lockdown on growth, while the government has said it will resume programs to assist affected workers and businesses that could cost billions of dollars. New Zealand has so far largely kept the virus out of the community, allowing its economy to recover quickly during the pandemic, but a slow vaccine rollout has left it vulnerable to another outbreak, particularly of the Delta strain that is challenging virus containment efforts around the world. Under so-called Alert 4 level, all schools, public venues and most businesses must close, and people are urged to wear a face covering if they need to venture out. Only shops providing essential services such as groceries, gasoline and health products can stay open. Less than 20% of the population is fully vaccinated. The Health Ministry said one of the new cases is a workmate of the original case and the other 3 are contacts of the workmate. One of the 3 contacts is a fully vaccinated health professional employed at Auckland Hospital, which had been working in recent days, and hospital authorities have taken immediate action to shut down any potential spread, including testing all staff and patients on the ward the health professional worked on. So the Reserve Bank of New Zealand announced that the Monetary Policy Committee agreed to retain the current stimulatory level of monetary settings and kept the official cash rate at 0.25% for now. They said today's decision was made in the context of the government's imposition of level 4 COVID restrictions on activity across New Zealand. The committee, they said, will assess the inflation and employment outlook on an ongoing basis, with a view to continue to reduce the level of monetary stimulus over time so as to best meet their policy remit. This follows the recent halting of additional government bond purchases under the large-scale asset purchase programme in July. They said global monetary and fiscal settings remain at accommodative levels, supporting international spending and investment. Rising vaccination rates across many countries have provided economic impetus, and the rise in activity has continued to support demand and prices for New Zealand's export commodities. However, the need to reinstate COVID-19 containment measures in some regions highlights the serious health and economic risks posed by the virus. Persistent and elevated health risks are promoting ongoing global supply chain disruptions and are acting to constrain productive capacity and prolong inflationary pressures. Today's reintroduction of level 4 restrictions to activity across New Zealand is a stark example of how unpredictable and disruptive the virus is proving to be, they said. The committee noted that the New Zealand economy had rebounded more strongly than most countries, with less domestic disruption caused by COVID-19 to date. Employment is currently at or above its maximum sustainable level, and consumer price inflation expectations remain anchored near 2%, the midpoint of the target range. Recent data for the New Zealand economy suggests demand is robust and the economic recovery has broadened, despite some weaknesses persisting in the sectors most exposed to international tourism. Household spending and construction activity are at high levels and continue to grow, and business investment is responding to increased demand. Capacity pressures are now evident in the economy, they said, particularly in the labour market, where job vacancies remain high despite the recent decline in unemployment and underemployment. Wages are rising consistent with the tight labour market conditions. Broader inflation pressures are being accentuated in the near term by one-off price rises, such as higher oil prices, and temporary factors such as supply shortfalls and higher transport costs. Near-term consumer price inflation is expected to rise above the committee's target range before returning towards the 2% midpoint around mid-2022. And the committee agreed they are confident of meeting their inflation employment remit with less need for the existing level of monetary stimulus. However, the committee remains alert to the supply disruptions that COVID-19 can create and the dampening effect this can have on confidence. House prices are also above their sustainable level, heightening the risk of a price correction as supply increases. The committee agreed that their least regrets policy stance is to further reduce the level of monetary stimulus so as to anchor inflation expectations and continue to contribute to maximum sustainable employment. But they agreed to keep the OCR unchanged at this meeting, given the heightened uncertainty with the country in a lockdown. In a way, that's quite convenient. The Reserve Bank now has a perfect alibi to keep rates really, really low, while still jawboning house prices as a risk, etc., etc. The fact is, they probably didn't really want to turn the dial up anyway. So the convenience of the COVID landing just now is pretty manifest for everybody to see. Now, back here in Australia, it's official. The Morrison government has launched yet another housing affordability inquiry. Yawn, yawn, yawn. This time examining, quote, supply side impediments. Here we go again. The federal government looking at a very myopic view of pricing and housing and all those things, and blaming the states and blaming supply side issues, while not accepting the truth that this is all debt driven, it's all central policy driven, and it's low interest rate driven. And here's a bit of spiel from the coalition committee trying to explain why they're going to do it. As data provided by the Reserve Bank of Australia, the Treasury and the Australian Bureau of Statistics shows home ownership, one of the building blocks of Australian society, has been falling in the past 30 years. This represents an urgent moral call for action by governments of all levels to restore the Australian dream for this generation and the ones that follow. Arguments about the impact of increased subsidies and tax concessions on housing have continued for some time. There is ample evidence that points to the small effect such measures have on supply. Indeed, the research points to limitations on land and restrictive planning laws as the major causes of shortages in supply. As consistently noted by the RBA and others, regulatory settings are directly responsible for the unresponsive nature of housing supply in Australia. The OECD conducted an analysis of Australia's housing market, particularly its very high ratio of housing prices to household incomes. The OECD concluded that Australia's unusually high level of elasticity in housing is the major driver of this ratio. This has resulted in our country having the fourth fastest house price growth out of the world's advanced economies over the past 20 years. This is best demonstrated by the fact that total residential private building approvals decreased 44% across the nation from 2016 to 2020 compared to the previous 5-year period, according to the ABS. And while market supply has collapsed with new home listings down to record lows, according to CoreLogic, using the most recent 5-year average. It is with this context that the House of Representatives Standing Committee on Tax and Revenue will investigate the impact of tax and regulatory regimes on price, affordability and supply of housing in Australia today, as well as to the future. Now, realestate.com.au called this inquiry, quote, a win for home buyers, because home buyers are set to be the winners of the biggest shake-up of property taxes and red tape impacting affordability, with a federal inquiry launched to zero in all arms of government doing the worst damage. But here we have it once again. This is fundamentally missing the point. Housing is so unaffordable because mortgages are too cheap, interest rates are too low, lending standards are too loose. It's a credit-driven bubble. It is not a supply-driven problem. But of course, neither the government nor the APRA nor the Reserve Bank wants to take any accountability for the fact that they've really messed up over the last 20 to 30 years. So they create another inquiry over here to look at a small side issue. Supply is not the major issue. There's lots of spare property around. There's more being built already. And frankly, just messing with taxes on the edge of things will not fundamentally give the property market the trajectory that it needs. We are in the middle of a debt-driven bubble, which will continue for as long as poor lending standards continue, low interest rates exist, and everybody wants to blame everything but the real reason why it's happening. And it's worth recalling that there have been numerous housing affordability inquiries over the decade. For example, the Mendes Research Centre Prime Ministerial Task Force on Home Ownership in 2003, the Productivity Commission's first home ownership report in 2004, A Good House is Hard to Find report from the Senate Select Committee on Housing Affordability in Australia in 2008, the Western Australia's Affordable Housing Strategy of 2010 to 20, the NHSC State of Supply reports, many different dates, the Senate inquiry into affordable housing in 2014 and 15, and the Parliamentary inquiry into home ownership in 2015. Yeah, so many inquiries, so many missed opportunities, but frankly, so many times when the message is were just scrambled from the beginning. And I don't forget, of course, the recent Royal Commission, which revealed just how badly lending had gone in Australia and how the banks were just pushing loans to people who could never afford to pay them back. And then, of course, we've also got many reports from think tanks like the McKell Institute, the Grattan Institute, and others, and my own research as well. The fact of the matter is, we are maxed out in terms of reports. We are maxed out in terms of inquiries that don't cut to the core issue. What we need is a fundamental set of issues looked at here relating specifically to credit supply and the relationship with home prices. As the Reserve Bank said, if you cut interest rates by 1% or 100 basis points, prices will rise by 30% over the next 3 years, all else being equal. And the reverse is also true. And that is the simple, bald truth. It is a credit supply issue rather than a building supply issue that's actually the critical issue. And frankly, dealing with housing affordability without dealing with the elephant in the room, the credit problem, is actually just more noise, signifying very little at all. But of course, the government then claim that they're doing yet more on housing affordability. I expect to see many more announcements about helping first-time buyers into the market, etc., etc. But again, it's missing the point. The bottom line is this: credit is the problem. Too much credit is available, stoking house prices higher. The banks love it because their balance sheets grow, they make more profits, but ordinary households get crushed in the crossfire. And until that is understood and policies are changed, things are going to continue very much the way they are. Come yet more inquiries with no different outcomes. According to the ABS, the seasonally adjusted wage price index, the WPI, rose just 0.4% in the June quarter of 2021, with the annual growth rate at 1.7%. The ABS said the June quarter saw the rate of growth in hourly earnings eased to 0.4%, following 2 quarters at 0.6% wage growth. The rate of growth over the quarter was one of the lowest rates recorded for the series. Apart from a few isolated examples of skills shortages placing pressure on employers to meet expected market rates, the private sector wage rate growth recorded over the quarter of 0.5% was generally subdued. Public sector wages rose by 0.4% for the third consecutive quarter, dampened by ongoing negotiations around new enterprise agreements and the postponement of scheduled wage rises. Compared to the June quarter 2020, private sector hourly wage rates rose 1.9% in the June quarter, and the annual rate of private sector wage growth was influenced somewhat by the initial dip in wages recorded in the June quarter of 2020, when the first impacts of the COVID-19 pandemic were recorded in the WPI series. The public sector recorded its lowest annual rate of growth at 1.3% since the series commenced in 1997. In original terms, the lowest quarterly wage growth by industry was 0.1% for the electricity, gas, water and waste services, transport, postal and warehousing, healthcare and social assistance and arts and recreational service industries. The highest was 0.6% for the rental, hiring and real estate industry. Across the country, rates of growth varied, with the Northern Territory recorded the lowest quarterly growth rate at 0.1%, while the ACT recorded the highest at 0.6%. So absolutely nothing here in this data to suggest anything other than the continued grind in real wages is going to continue. And of course, with inflationary pressures building in some sectors of the community, this is going to add ever more pressure to people struggling to maintain those bigger mortgages ahead. And I'm afraid that for me, the expectation of any future significant wages growth is just a mirage. It ain't going to happen anytime soon. Over in the US, retail sales fell in July by more than forecast, reflecting a steady shift in spending towards services and indicating consumers may be growing more price conscious as inflation picks up. The value of overall retail purchases dropped 1.1% last month, following an upwardly revised 0.7% increase in June, according to Commerce Department figures. The median estimate of economists was actually just a 0.3% decrease. Excluding autos, sales decreased 0.4% in July. Total receipts trailed estimates by a wide margin, as declines in motor vehicles and e-commerce sales weighed on the figures, and restaurant spending increased, though at a more moderate pace than in previous months. The emergence of the Delta variant could curb demand for services like travel and entertainment going forward, and higher prices for things like groceries, meals out, personal care and apparel also risk limiting discretionary spending in the coming months. A report last week from the University of Michigan showed buying conditions deteriorated to the lowest since April of last year as inflation remained elevated. And the retail sales data are not adjusted for price changes, by the way. The figures on Tuesday point to a softening in third quarter consumer spending growth, and economists forecast outlays to grow at an annualized 4.5% in the current period, significantly slower than the pace estimated a month ago, and a sharp deacceleration from the sizzling 11.8% rate seen in the second quarter. Morgan Stanley economists, led by Ellen Zenter, said the weakening in sales lowered their tracking estimate for third quarter economic growth to 6.5%, the same as last quarter from 6.9%. And stocks dropped after the report. Traders also digested separate data released on Tuesday, showing US factory output rose more than expected in July. And this week will also include earnings reports from many retailers, including Target and Macy's. Earlier on Tuesday, Walmart posted stronger than expected comparable sales, and the giant boosted its full year outlook. Results from Home Depot, however, showed weaker than expected results that signal a cooling in the home improvement boom. According to the Commerce Department's report, that drop in July sales was fairly broad, with 8 out of 13 categories registering decreases. Sales at restaurants, the only services spending category in the retail report, rose 1.7%. That's the smallest advance in 5 months. Restaurant spending could soften in the coming months depending on the path of the Delta variant. Total card spending from Bank of America deaccelerated at the end of July, while open table restaurant bookings have moderated. Motor vehicle and parts dealer sales slumped 3.9% in July after a 2.2% slide a month earlier, likely in response to limited inventory and higher prices as automakers face supply chain constraints. Sales at non-store retailers, which include e-commerce, fell 3.1% in July, a sharp slowdown from the prior month, likely reflecting Amazon.com's move of Prime Day, an annual sales event for online shoppers, to June. There were also declines in sales at apparel retailers, building supply outlets and furniture stores. So-called control group sales, which are used to calculate gross domestic product and exclude food services, auto dealers, building material stores and gasoline stations, dropped 1% in July. Now on the monetary policy front, Federal Chair Reserve Jerome Powell largely stuck to his script in a town hall meeting on Tuesday. Powell reiterated that the recovery in the labour market is far from complete and said that it wasn't clear how big an impact the Delta variant will have on the economy. The Fed chief's comments come ahead of the minutes from the Fed's most recent meeting and the Jackson Hole Symposium next week, when some expect there could be clearing signals on tapering of monthly bond purchases. But the Fed is likely to take a cautious approach rather than an aggressive approach to reducing its monthly bond purchases. If Powell does commit to a time on tapering at Jackson Hole, he could signal the end of the year or the very beginning of next year, Williams said. I think it's going to be very slow, very deliberate, and it will be very market-driven. If the market has a taper tantrum, I think they'll slow down. The S&P 500 actually snapped a 5-day winning streak on Tuesday, led by a drop in consumer discretionary stocks following weaker quarterly results from Home Depot and worries about the consumer amid data showing retail sales slipped to a 2-month low. The S&P 500 fell 0.7%, the Dow Jones Industrial Average slumped 0.8%, and the Nasdaq was down 0.9%. That drop of 1.1% in retail sales in July was way more than the 0.3% expected, and that, of course, is linked to autos, building materials, and non-store retailing. There are two caveats, however. Since April, there have been consistent patterns of upward revisions to retail sales, so it is possible that the momentum will improve with the next release, Jeffries said. Cyclicals, including industrials, materials and consumer discretionary, were in the red, with the latter down more than 2% amid pressure from retailers including Amazon and Home Depot. Home Depot fell more than 4% after reporting weaker than expected second quarter comparable same-store sales that offset quarterly results that beat both the top and the bottom lines. While big-ticket demand continues to outpace supply in some categories, slowing demand in smaller ticket categories is likely a leading indicator of slowing comparable growth in the future, Wedbush said. Walmart raised its full-year guidance after reporting better-than-expected second quarter results, but its shares ended flat. Technology stocks, meanwhile, struggled to replicate their positive start of the week, falling 0.9%, as Apple, Microsoft, Facebook, and Google parent Alphabet were below the flat line. Healthcare stocks shrugged off broader market malaise, though, led by a 7% surge in Moderna, as the UK on Tuesday approved the use of Moderna's COVID-19 vaccine for 12 to 17-year-olds. Other vaccine stocks, including Pfizer and Novavax, were also higher on the day. Finally, coming back to Australia, Domain says it will repay JobKeeper. The property listings group has committed to returning millions of dollars in JobKeeper subsidies to the government while it expands its broker business. In fact, Domain produced a net profit of $37.9 million for the 2021 financial year. That's 66% more than the year before, while earnings before interest, tax, depreciation and amortization was up by 19% to $189 million. On a like-for-like basis, Domain delivered $289.6 million in revenue, which was 9.7% more year over year. And the group indicated that it was optimistic around the property market despite the ongoing lockdowns. Well, they would say that, wouldn't they? As a result, Domain has decided to maintain its growth strategy and to pay back $5.7 million in JobKeeper grants it received during the financial year 21, which will be deducted from its financial year 22 earnings. In the financial year 22 year-to-date, national listings are slightly up on last year. While listings volumes have been impacted by lockdowns, particularly in Sydney, July continues to deliver strong national depth performance, Domain Chief Executive and Managing Director Jason Pellegrino said. We remain confident in the resilience of the market, as evidenced by consistent patterns of sharp rebounds when restrictions ease. However, the group's consumer solutions business, which includes mortgage brokerage, Domain home loans, experienced $6.2 million in EBITDA losses. Other businesses under the consumer solutions umbrella include home and contents insuring arm Domain Insure, utilities arm Domain Connections, and Domain for Homeowners, a personalised extension of the property platform. The earnings loss had grown from the year before, when the segment had posted $3.6 million in EBITDA losses. Mr. Pellegrino reported the hit derived from Domain Home Loans scaling up its headcount to address operating constraints. Expenses of $11.7 million for consumer solutions had increased by 27% from financial year 20, reflecting boosted investment in Domain Home Loans and Domain Insure. Revenue from the consumer solutions segment was mostly stable, slipping by 1.2% to $5.5 million for the financial year 21. And Domain Home Loans had contributed 2% to the division's revenue, with the mortgage broker's underlying revenue growing by 12%. New accounts with Domain Home Loans has grown by a third during financial year 21, while unconditional approvals were up by 29% and settlements rose by 20%. Mr. Perrogo commented the broking business is expected to ramp up its growth in the coming year. Improving fourth quarter conversion metrics, scaled up headcount, and a new management team are expected to accelerate future performance, he said. Domain Home Loans recently hired former BrickX boss and Deloitte partner Caroline Crowe as its new general manager and chief executive. During financial year 21, Domain's core digital division, including residential, media developers, and commercial and agent and property data solutions, increased its revenue by 17% year over year to $265.5 million, while EBITDA rose by a third to $130 million. Meanwhile, revenues from the print magazine's business declined by a third to $17.8 million, particularly as publishing activity hit a pause during COVID. Mr. Pellegro reported the mastheads had only published 68% of their usual schedule in financial year 21. So kudos to them for handing back JobKeeper when they don't need it. Other organisations, please note, this is a good thing to do. But also, I wonder about how cautious they should be with regard to prospective growth, because, as I've highlighted already, I think that the Delta variant is not going to get under control anytime soon, and I have my doubts about whether the vaccination rates that we're targeting will be sufficient to really get things back under control. I think the long, slow grind is still ahead, but we'll see. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.